10 years ago, a woman I'll call Fatima did something a lot of people quietly do, even if they'd never admit it out loud. She didn't trust banks or the stock market, so she took $30,000 and hid it, literally, in a safe in her closet. At the exact same time, her cousin took the same $30,000 and put it into a simple total market index fund instead. Today I'll show you what actually happened to both piles of money, and the gap will change how you see cash in a drawer. Before the numbers, let's understand why people do this. It's not irrational, it comes from a real, understandable emotional place honestly. Some people watched a market crash destroy their investments overnight, and that fear never fully left them, even years later, quietly lingering. Some just want the psychological comfort of physically touching their money, rather than trusting a number sitting on a screen somewhere distant. On the surface, cash feels safe, it can't crash, and $1,000 in a drawer today is still $1,000 tomorrow. But here's the problem with that logic, and it's the entire point of this video: cash isn't actually safe, it just fails slowly. Here's the number nobody thinks about when stuffing cash into a mattress or a safe for years at a time: inflation, quietly working. Inflation is the gradual rise in prices over time, meaning the same dollar buys less and less as years pass by steadily. Historically, inflation in the United States has averaged around 3% yearly, though it's varied, with sharp spikes in certain periods. If inflation averages even 3% a year, your cash's purchasing power gets cut roughly in half every 23 to 24 years. Over just 10 years at that rate, $30,000 untouched dollars loses roughly 20 to 25% of its real purchasing power quietly. So Fatima opens her safe after 10 years, and there it is, $30,000, exactly as she left it, nothing missing. But that $30,000 doesn't buy what it used to: groceries, rent, and cars all cost noticeably more than before now. In real terms, her $30,000 now behaves more like $22,000 to $24,000 did a full decade earlier. She didn't lose money on paper, she lost money in reality. That's what makes this the silent killer nobody notices immediately. Now let's look at her cousin's $30,000, invested in a total market index fund and left completely alone for that decade. Historically, a diversified index fund has returned around 8 to 10% yearly on average, though individual decades swing above or below that. Even using a conservative 7 to 8% average annual growth, that original $30,000 could have grown to $59,000 to $65,000. Fatima's cash, adjusted for real purchasing power, shrank to roughly $22,000 to $24,000, while her cousin's investment grew to about $60,000. That's potentially a difference of $35,000 to $40,000 in real, usable purchasing power, from the same starting amount, same 10 years. Now, some of you are thinking, but what about market crashes? What if she'd invested right before one hit unexpectedly? That's a fair concern worth addressing honestly. Markets do crash sometimes, and needing money immediately during a crash genuinely hurts financially. This is exactly why an emergency fund, typically 3 to 6 months of expenses in a high-yield savings account, makes practical sense. But we're talking about long-term savings here, not emergency funds, and historically, the market has recovered from every crash and reached new highs. Time in the market smooths individual crashes into a longer, steadier upward trend, making starting timing matter less over a full decade. Cash doesn't crash, but it guarantees a slow, quiet loss of value every year, with certainty, regardless of what the economy actually does. This brings us to the actual myth worth naming clearly, that holding cash is safe and investing is inherently risky by comparison. That framing is backwards. Cash carries a guaranteed risk, the certain erosion of purchasing power, with essentially zero chance of avoiding it. Investing carries short-term volatility, but historically, over long periods, that volatility has been rewarded with growth that outpaces inflation comfortably. The real question was never is there risk. There's risk either way, the question is which risk you're actually knowingly choosing here. Most people avoiding investing because it feels risky have unknowingly chosen the option with a worse, more certain outcome over the long run. Now, to be fair, cash absolutely has its place, and this isn't an argument against ever holding cash at all, honestly. Your emergency fund should genuinely be in cash or a high-yield savings account, because instant, guaranteed access matters when you need it desperately. Money you'll need within 1 to 3 years, a down payment, a wedding, probably shouldn't sit in the stock market either. But money that's genuinely long-term, untouched for 5, 10, 20 years, sitting as literal cash just guarantees a slow, avoidable loss instead. So here's a simple, honest framework: keep 3 to 6 months of expenses in cash as your true, untouched emergency buffer always. Keep money needed within 1 to 3 years in stable, low-risk places too, not exposed to short-term stock market volatility and swings. For genuinely long-term money, a diversified, low-cost index fund has historically outperformed cash once you account for inflation eating away constantly. The goal isn't zero risk, that doesn't exist. The goal is choosing the risk that's historically worked in your favor over time. So here's the honest reality check: Fatima's safe cash quietly lost real value every year, hidden behind a number that never changed. Her cousin's risky index fund, despite short-term ups and downs, grew into meaningfully more real purchasing power over that exact same decade. Cash isn't actually safe, it just fails quietly instead of loudly, which somehow makes it feel less dangerous even when the outcome is worse. If you keep large cash savings beyond your emergency fund, I'm not saying panic and move it today, that's a personal decision. But now you've seen what that quiet decision has historically cost people, in real, concrete numbers most people never actually calculate themselves. Tell me honestly in the comments, do you keep cash savings beyond your emergency fund? I genuinely want to hear your reasoning. If this gave you a clearer way to think about where your money sits, hit subscribe for next week's honest breakdown too. I'll see you in the next one. Thanks so much for watching, and take care of your money wisely.